Okay, everybody, good afternoon. Again, this is Mario Sonardi. I hope everyone is doing well, and I wanted to welcome you to our Thursday afternoon webinar here. We have a special guest who's going to be going over some training from Jackson National Life, Mr. Doug Kress. So we're happy to have him with us, and he's going to be going over some good information. Given a few minutes for anyone else to get on. I know we're going to be recording this as well for training purposes only for anyone that needs to catch up with it later. So before I bring on Doug, I just wanted to mention, as you can see from our slide there, strength and selection. One of the great things about our firm with Transamerica Financial Advisors is that we do have a lot of strength and selection. We have a lot of options for our customers, our clients, our prospects, our families, and we're able to do a lot of great things for them. And when you look at some of the companies that we represent, our main product providers there, as you can see, Jackson there on the top right, and we're honored to have Doug with us, and really we're fortunate to work with a great company like Jackson, and I know Doug can share more information about their strength and where they're positioned and all the great things they do. But I can just say personally, and I know many others with our firm that have used Jackson for our families, they do a great job. We've served many families with Jackson on not only the accumulation phase, but also the income phase, and able to help them with many great products that they have, as Doug will cover. So they're a great product provider that we have with us, and we're fortunate again to have them, as well as many others that we work with. And when you look at some of the products under the variable annuity category, you see Jackson National Life there, and it's a great product to have and work with our families on, and making sure that they're getting the best possible experience when it comes to their retirement planning, whether they're looking 20, 30 years out, or they're maybe in the middle of retirement now and looking another 20, 30 years now in distribution. So whether it's accumulation or distribution, I know we can serve them well. So with that, I'm going to turn it over here to Mr. Doug Kress. He's Regional Vice President with Jackson National Life. And before I do that, I do want to mention again, this is for training purposes only. This is, not to my legal disclosures, right? We're not here to give tax advice or legal advice, and we want to make sure this is for training purposes only, or not to solicit any products on this webinar. So just keep that in mind as we review this information. So without further ado, Mr. Kress, can you hear us okay? Are you able to, I made you a panelist. You should be able to share your screen and talk.
Perfect. Can you hear me?
Yes, we can hear you.
Awesome. And I will try to share my screen here. You cannot start your video because the host is disabled. Okay. Mario says you haven't, I think you got to hand over the host controls to me.
Got it. Let me put you back to panelist and see if that'll work. Should be good to go now.
Perfect. You cannot start your video because the host is disabled. It's still not allowing me to share my screen.
Try that now. Let's see if that make you a co-host there. That should work. There we go. We see you now.
Okay.
Perfect.
Well, good afternoon, everybody. As Mario said, my name is Doug Kress. I'm the external wholesaler with Jackson that covers our variable annuities with you guys. And I first and foremost want to say thank you so much, because I know there's a lot of premium that has been written with Transamerica and the advisors on this phone call. So first and foremost, I want to say thank you, because you've certainly helped put food on my family's table. So certainly thank you very much. What I wanted to do today was give you ammunition for variable annuity sales, because they are selling a lot right now, which I don't think is a surprise to anyone, given the market conditions that we've been seeing with the volatility, but more importantly, the interest rate environment. So I want to give you some ammunition that you can put in front of clients, and say, hey, there's been a time that annuities, it was very difficult to find a positive article of annuities, but now you don't have to look very far to find them, which I'm going to share a few of my favorites with you today. And then I'm going to share with you a couple simple and easy sales ideas for Jackson. We continue to lead the industry in terms of the variable annuity sales. Anybody that's using an income rider tends to look at Jackson and put that business with us, and I'll share some of those numbers with you in just a moment. But first and foremost, the most important thing is, Doug, give me some ammunition. I can talk to clients till I'm blue in the face about annuities, but the perception that we've had over the past 10 years wasn't very positive. And when you're seeing a low volatile environment and the market just looks like a hockey stick when it's going up, you can kind of understand why clients don't want to look at annuities, because they just have this feeling they forget about 2008 and some of the things that can happen in the past, where they don't think they need protection in the portfolio. Well, we were reminded again here in March and April of why we need some of our assets in a solution like that. And that's what sparked some of these positive articles. So the first article that I want to share with you, you all will love this. This is Suze Orman. And let me go back to the title of it so you can write this down. So Suze Orman, make these moves to keep your retirement savings on track during coronavirus. So I have heard, many years throughout my career that Suze Orman hates annuities. We sat down with her, we educated her, and she actually wound up buying her own variable annuity from Jackson. So this is a Suze Orman article. I'm going to scroll down, I think the page reloaded on me, to the part where she talks about annuities as it needs to be a part of the portfolio. So I'm scrolling down, income annuities. I'll just share with you the parts of the article that I like. If you're investing in the stock market and the market isn't going well, you need guaranteed income for you to live on. You have Social Security and that's it. And that's what these solutions are designed to do, is supplement Social Security or possibly a pension if your clients are fortunate enough to have one. You can, and then she goes on to say you cannot count on income from stocks and bonds anymore. So this is just an article that I have found here recently that Suze Orman actually is talking positive of annuities, which I found very ironic. The second article that I want to share with you is from an CNBC article. It's an op-ed. With today's market volatility, the 4% rule creates risk for America's retirees. So I just want to touch on the bullet points and go into a little bit further depth. Everything in our career, since I can remember, we've been taught, if you have a mutual fund portfolio, an ETF portfolio, an advisory portfolio, you can take 4% out of that portfolio and you'll be in the 90% range that you'll never run out of money. So if you have $1 million and you distributed 40 grand a year, there's a 90% chance that you never ran out of money. But the problem is today's interest rate environment is so low and dividends are so low that it's very difficult to create 4% out of a portfolio. So that rule may be obsolete. And then the last bullet point, annuities are the only financial product that was designed for and specifically protected lifetime income. So I would certainly write the title of this article down. I'm not going to go into all the details in the article, but it is very, very good and paints annuities in a positive light. But I want to go into a little bit more depth here and show you exactly in simpler terms what they're discussing here. So in 1990, if we look at dividends back in 1990, this is how we create income out of a portfolio, is through dividends out of stocks and yield out of bonds. And if we look at what the S&P 500 dividend was back in 1990, it was 3.9%. But the bigger income stream came from bonds. The 10-year treasury back in 1990 was at 8.9%. So if you went 50-50 between the S&P 500 and 10-year treasury, you were creating much more than 4%. You were creating 6.4%. So you could create 64 grand out of this portfolio without ever touching principal, just taking a dividend and the yield. So where's the problem lie? Why are annuity sales significantly up this year? And I think they would be even more up if the quarantine didn't just go into place and advisors were able to see their clients for 2 months. So the problem consists right here. The S&P 500 dividend today is sitting at 1.9%. But the bigger issue is you have the 10-year treasury floating between 0.6 and 0.7%. So that same $1 million back in 1990 that created 64 grand, it creates 13 grand today. Here's the issue, folks. This is why annuities are selling, and it's for every single company. It's not just for Jackson. It's every company. So here's the issue, and that's what that article is explaining. And then the last article that I'll share with you is it comes from Barron's. It's titled "The Bear Market Can Derail Your Retirement If You're Not Careful." You can Google any of these, and they should pop up and ready for you to print. The one thing I wanted you to see on here is Wade Pfau, who is a mathematician. He's very, very intelligent. He's a retirement income expert. He says, listen, if you're owning those types of investments where you have advisory and you have mutual funds, you're not a believer in annuities, I recommend you take anywhere from 2.4 to 2.8%. 2.8% is on the high end. So 2.8%, no more, you're going to run the risk of running out. From an environment where we were taught you could take 4% out. So there's the issue, 2.4 to 2.8%. And I'll just show you this article very, very quickly, just because I love the first sentence. This one is from Kiplinger's, look for guaranteed lifetime income, ? I love the first paragraph. To an economist, an annuity is the most sensible way to provide safe income in retirement. In fact, economists spend more time researching why more Americans don't buy annuities than they do estimating whether annuities are a sensible investment for their portfolio or not. And that's the truth. We spend so much time on costs and fees and the characteristics of the roll-ups and the income than actually discussing this is what it's going to do for you. It's going to provide an income stream, just like your pension, just like your Social Security. You're going to sleep at night. The money stays invested. There's protection. No matter if COVID stays around another 5 years, no matter who's president, there's a lot of issues going on in the world right now. Clients are looking for these types of strategies, and 80% of clients care more about sustainable recurring income than they do than an asset. What I mean by that is they would rather have a pension. They would rather trade their 401k in for a pension. We have that strategy for them today. So those are the 3 articles that I wanted to share with you. The other thing that I wanted to show you is if you compare, this is really why a variable annuity. And then here's your other options. You have mutual funds, advisory, you have CDs, you have fixed annuities, you have index annuities, you have REITs, whatever you want to put in this column here. I'm going to compare and contrast. Why not do a variable annuity for at least a portion of the money? Because I'm going to show you how this will generate more income than the other strategies available. So I've always said our sweet spot is 55 and older. If you know any 55 and olders, I would at the very least bring this conversation up, because this is on their mind. They're worried about their income. We've seen a lot of jobs lost over the past few months, and states are discussing going the opposite direction with these closures and phases. I don't know if it's going to happen, but that is something that they are discussing. So you can bet that clients are worried about whether their income is going to maintain forever. So at 55 and older. So I want to give you a quick sales idea. 60-year-old. I know I said 55, but to keep numbers simple, I'm going to use a 60-year-old with $1 million. The only reason I'm using $1 million is to keep numbers simple mathematically. But this client comes to you and says, you know what? I am done working at 65. I no longer want to work. At that point in time, they're going to start withdrawing out of their portfolio. We right now today have a 7% growth rate on our living benefit. In a week and a half, that is going to 6%. So today it's at 7. We know 5 years from now, your pension value, your income value will grow to $1,350,000. Guaranteed. No, I'm totally taking the market returns out of it. At 65, we have 5% income. These two rates are extremely attractive given the 0% world we live in today. So I know worst case scenario, Mr. Client, your income in 5 years will be this. It could be more, but guaranteed it's going to be this, $67,500. Guaranteed to happen. These are on assets that you absolutely know you are going to live off of when you retire. Okay, so I'm going to compare and contrast my VA versus these other strategies in the industry and what they will have to do to what I will do guaranteed. So I'm going to move this number over here, 67,500. I just spent the first 4 or 5 minutes discussing how the 4% rule potentially is in jeopardy due to interest rates, due to companies lowering their dividends if they haven't cut them. So it is very difficult to create 4% income. It's 2.4 to 2.8. However, I'm still going to play in that unrealistic environment. I'm going to use 4%. So 67,500 divided by 4%, my $1 million in 5 years needs to grow to $1.7 million. Mr. Client, that rate of return from here to here is 11.2% compounding. You have to do it. If we don't do it, we should have just put our money in the annuity. But we have to do it. The problem with this scenario is you have to be willing to do it completely naked. You're fully exposed with no protection pieces. I know this. CDs will not do 11.2% compounding. Fixed annuities will not do that. Index annuities, they're an interest rate sensitive investment. They will not do that. REITs, it's kind of difficult when tenants are defaulting on their rent payments and properties aren't selling. And I've been putting a question mark up here by the other two. The reason I'm putting the question mark up there is because I know up here we have to hold bonds. I don't know what your opinion is. I know the majority of people I discuss bonds with, but as soon as rates start rising, we're going to start losing money in bonds. And for these two types of portfolios, you have to hold bonds for diversification and fiduciary responsibilities, lowering the client's risk. So I don't know how realistic 11.2% is, but let's say it's easily obtainable. I'm totally wrong, and we can blow 11% out of the water over the next 5 years. I believe we can do that, but you're going to have to be heavily allocated to equities. But if we do this 11% compounding, the only thing that changes in my scenario is this number now goes up because we got step-ups along the way. You can bet if we did 11.2% compounding for 5 years, we got step-ups. Well, that means this number just went up because now we're getting 5% off of a higher number. The problem is every incremental increase here, this has to do more. So if my 67,500, I get one step up, I have to have now a higher rate of return. So all I'm telling you is whether it's fixed income assets, equity markets, show them this variable annuity. I'm not going to hinder your returns. I'm going to give you a high yielding bond in terms of income. It's a corporate rated AAA bond backed by Jackson, where A's across the board, with equity performance. You're giving them a triple whammy with our variable annuity. Equity performer, high yield generating income, and AAA ranked rated bond. So that's why our variable annuity, and specifically our variable annuity, and what sets us apart is a fundamental difference between the way we allowed you to grow your money. I'm going to just show you our investment lineup, and then I'm going to go over two more simple ideas. We have 140 different investment options with no restrictions. This is Jackson's value proposition. We give your client the best ability in the industry to grow their money. We have zero restrictions. We don't say, hey, 10%'s got to be in bonds, 20%'s got to be in bonds. There's no algorithms involved. We don't play any games. Invest the money however you and your client feel prudent. I believe that you should be a little bit more aggressive inside of these vehicles because you're paying the insurance company to transfer the risk. So you can see we have a lot of investments to choose from. Don't be overwhelmed. I can help you with this. Our team of investment professionals can help with this as well. So don't be overwhelmed with our investment lineup. To give you an idea, when I say that we're pretty good in the VA space, the 2019 numbers and total annuity sales just came out for 2019. You can see that Jackson led the way again at 14.6 billion, almost 14.7. We led the way in total annuity sales. I would like to just touch on this for a minute. Equitable Financial, that's AXA. They have a captive sales force. Like you guys, I know your name is Transamerica, but if they said, you know what, guys, you can only sell the Transamerica product, that's it. Transamerica is going to get more business just because they have a sales force distributing their product. So AXA, or they call them Equitable now, Equitable Financial, they have a captive sales force. We don't compete against TIAA-CREF. Lincoln Financial, same exact thing. If they write the Lincoln product, they get benefits and little trinkets for writing that product. Prudential, same thing. They have a Prudential sales force. So we get down to AIG before we get apples to apples competition. You can see there is a significant difference between what we are doing and our competitors are doing. And it comes down to the engine under the hood, the investment freedom. So now I'll get into the benefits, where to use us. I like to keep stories simple. There's really three silos you need to think about Jackson and where to use us. The first silo, this client needs maximum death benefit. They need no income. Okay? So they're not looking to generate income. They got pension, Social Security, they have other income streams coming in. But what they didn't have is they didn't set up life insurance at an early age. And at this stage of their life, they either A, can't get life insurance, or B, they can't afford the premiums or don't want to afford the premiums. So they're not going to add an income rider. All they're doing is adding an enhanced death benefit. We have a 5% compounding death benefit that will ratchet with the market every quarter. Okay, so you have the Cadillac of death benefits right here, 5% compounding, which is extremely attractive right now given a 0% world we live in. 5% with a quarterly ratchet. This is never money. We're never going to touch it. We're just growing it for the kids. Scenario number one. Scenario number two is somebody exactly opposite of that. We need max income, and we're not too concerned about death benefit. If there's money left over, that's great, but that's not the reason we're going to put this portion of the money into Jackson, into their annuity strategy. So we need max income. There's a lot of you, Todd Kemp, Pat Callahan, there's quite a few of you that are using this income rider. Right now, today, it's called Freedom 6 Net. In 2 weeks, it's called Freedom Net. The reason I love this rider is because it is entirely different than anything else you're going to see in the industry. You have two income streams. You have 5%, which is a guarantee, which is, by the way, one of the highest out there. But you also get profit sharing. So you're going to get your guarantee of 5. If there's ever any earnings in the contract, you're going to get profit sharing as well. So your income will range between 5 and 8.33 every single year. The average distribution rate is at 7.2%. It is our best income rider for clients that are looking for maximum income. So this is scenario number 2, maximum income. I'm going to show you a quick illustration just to show you the power of this living benefit. So what I'm showing you here today is an illustration that a client invests $1 million at 65 years old, and they're taking income immediately. You can see $1 million bucks. We're taking out 5%. I told you our floor is 5%. The reason I ran this illustration is for two reasons. Number one, I wanted to see a scenario. I ran this back in March and April when the market was down significantly. So I want to see a scenario where the portfolio gets hit really, really bad right off the bat in the first year. So you can see we invested $1 million, we took out 50, and the values were 700,000. No thanks, don't sign me up for that. I'm gonna go with a different advisor. But I'm doing this on purpose because I want to show you the power of what this rider delivers to the client. We all know on this call how annuities work. The only way our income will ever go up is if this value and your cash value surpasses that value. So I did this on purpose. I wanted to see a scenario where my cash value never exceeds $1 million. You can look at the illustration, it never happens. So theoretically, even with our other living benefits, our $50,000 should never have gone up. This should have never changed. But you can see it changes in the second year, third year, fourth year, fifth year, sixth year. It goes back down the guarantee for 2 years, back up, back down the guarantee, and it's up the remainder of the way. So why did that happen, Doug? And it's one of the things that I love talking about because it's different. Remember I said this income rider has 2 income streams. You have your 5%. I'm not saying that can never change. If you get a step up, it can change. But I'm showing you a scenario that we don't get a market step up. So 5%, and then the other income stream I call profit sharing. The company's technical term is earning incentive adjustment. You can see the additional income that this is generating. When we have actual growth and gains in the contract value, you're going to get additional income. So this is why you can see over here, the client's income went up those particular years. I know this is, I'm throwing a lot at you in a short period of time, but the one thing I want you to remember is this rider is designed for income, maximum income distribution. And if that's what we're trying to generate for you, got to give us a shot. Remember this, with this rider, with the profit sharing, we took out a total of $1,297,000. $1,297,000. And that was over an 18-year time frame. Divide that by 18, our average dollar amount was 72 grand. We divide that by our original deposit because we took income immediately. This rider is good for income later or income now. Our average distribution rate was 7.2%. That's what clients are looking for. And when you think about annuities, one of the biggest issues with them is cost of living adjustments. Well, usually inflationary periods, the markets are doing well. If the markets are doing well inside of this annuity, you're going to get more income to address inflation costs. So that's Freedom 6 Net, maximum income. One of the things that I've enjoyed doing with advisors over the past few months is I know that you guys have your choices of annuity carriers and they're all very good at what they do. What I've been doing lately is once you get an illustration, because with this new regulation best interest or Reg BI, broker dealers are now requiring their advisors to either show 1 or 2 different companies or 2 or 3 different companies. So what advisors are doing is send me that other company's illustration. I'll play in their ballpark. I'll play in an away game. And I'll run their returns with my solution, and I'll show you how we'll generate more income. So that's max income. And lastly, the last scenario of these clients, they need both. I need income, but I also need a legacy because we want to leave something to our kids and our grandkids. This rider is called Freedom DB. It's income for life with a non-reducing death benefit. I'll show you the one pager and then I'll open it up for any questions. Between Freedom 6 Net and this particular rider right here, it's our top two sellers. Let me go back for one moment. This will not generate as much income as net. It just won't. It's not designed to. However, it will leave more of a death benefit than if we were to take income out of the standalone DB. So you're meeting right in the middle. What are we trying to solve for? We have a solution for it. So this is the third and final rider where we fit. I'll show you the one pager on that again. So I know I went through that quick. So how does it work? The blue line would be your cash value, assuming we're taking out income. So I'm going to say it's the income is 4%. So we're taking out $8,000 each and every year, $8,000, and we do that for 10 years. So we've taken a total of $80,000 out. Let's say hypothetically the value of the contract at that point in time is $90,000, and the client passes away. We will now refund the original deposit back to the beneficiaries. We make them whole. So it's a spend it twice story. It's great for uninsurable clients that need access to the cash value. They need to use the money. And it's perfect for qualified money, specifically clients that are 70 to 75 that need to take out their RMDs. Utilize this for their RMD money because it's RMD friendly, and upon death, we're going to refund the original investment amount back to the beneficiaries. Perfect. So again, I know you guys have choices, and there's a lot of different companies in the annuity space that you could certainly choose from. We thank you for the amounts of money and the clients that you put with Jackson, and know that they're with a very strong company, a very stable company. So with that said, I will open it up for questions.
Thanks, Doug.
Okay, Mario, you still here? You able to see?
Yeah, we can see you, and if we have everyone has access, they can unmute themselves. If anyone has any questions, go ahead and ask Doug.
I think you can also click on the Q&A and
Yep.
ask a question as well.
And Doug, if you want to share your contact information, because I know a lot of people will probably be watching this later as a webinar, and this way they can get in contact with you directly if needed.
Perfect. I will I think the easiest way to do that is just share my screen and pull up my signature on my email.
That'd be great. Yeah.
So I'm Doug. I'm your external wholesaler. So I'm the top one, Doug Kress. Cell phone 630-399-0229, and Keaton Fate is my internal. He's awesome. He's very responsive. So just let us know what we can do for you. Now that I'm working from home, like a lot of you may be doing, I feel like I'm available 24/7.
Awesome. Yeah. Thanks, Doug. We appreciate that. Thanks for taking the time out to go over that product. It's a great product. Like you had mentioned, and we discussed earlier, you know, we've helped families with that product, and I know it's especially in today's economy, it's really doing its job, and it's great. So appreciate you sharing those little nuggets with us and those sales ideas. Anybody else have any questions you can ask now, or you can do a Q&A. Otherwise, you have Doug's information also. So I think we're good, Doug. Thanks again.
Awesome. Yep. Thank you for allowing me to be on the call. And if you have questions, please reach out to myself or Keaton.
Absolutely. Thank you, Doug.
Thanks, guys.
All right. Have a great day. All right. So we are gonna just wrap up here with a few things for our webinar today, since we're discussing annuities, and hopefully that can be helpful to you as we continue, um, working with companies like Jackson. And just a note, that's a variable product. You need a securities license to have that product and sell that product to clients. Just want to make sure everyone knows that again. And I know many are actually working on um, getting their securities license as well. So just keep that in mind, as it is a great um, product for us to use in the securities world. And the other thing I just want to mention again is, this everything that Doug went over, obviously, and I'm going to discuss is for training purposes only. We're not giving tax or legal advice or solicitation for any type of product. We just want to give some concepts and some information that's out there, and then obviously we take it back. We see what's in the best interest for the client, and hopefully can share some ideas that'll help you as you're out in the field and working with families, educating them.